of a big factory that can just churn out shirts really quickly, you'd expect the cost of those shirts to go down dramatically rather than kind of stay the same. So if they're staying the same, which they kind of have been, then you're basically seeing that it's the debasement, the denominator itself is kind of offsetting that. We're having more supply of dollars, whatever currency you can think of, and that's kind of offsetting the structural price declines. So despite the fact that technology makes everything cheaper over time, or most things cheaper over time, outside of wars and other big setbacks of productivity, central banks have positive inflation targets. They want to have prices that go structurally up, despite the fact that technically prices should go down. And so they manage that by encouraging more money creation, either from bank lending or fiscal deficits that they can monetize. And so to your question of can we grow out of it? Partially you could, if you had something that dramatically reduced the cost of energy and made energy way more abundant. Anything that massively increases productivity, like AI, offshoring and automation were the big productivity enhancers for the past few decades. That's why, for example, most of the inflation shows up in things like hospital services and childcare services and education, things that haven't really been automated that well yet, that actually require a lot of expensive domestic labor. Whereas anything that you can offshore would have zero supply growth. So you, in the long arc of time, fully diluted, zero dilution. Even now, the supply inflation rate is below that of gold, and will, because of the halvings, will asymptotically approach zero. And so that's kind of how you can think of dilution rates. And then when you look at, for example, the other factor to consider dilution, to finish that point, is market share. It's not just, you have to have something that's not just scarce, but is dominant for the thing that it does. So, for example, if you own IBM stock, right? IBM has been buying back its own shares. It's a deflationary asset. It's even scarcer than Bitcoin, right? The supply is going down. But IBM has structurally been losing market share in the whole tech infrastructure stack. Yeah. And therefore, your share of a segment of tech infrastructure, for example, is being diluted, even though your units of IBM are not being diluted, but IBM itself is being like pushed away by these other entities. And you're owning a piece of a shrinking pie. Oil, which we have gotten better at finding, but it's still fairly an energy intensive and scarce process. And then you go down to soft agricultural products, grains and soybeans. They'll be very good at making more of over time. Things like electronics. And so you have this like spectrum. And if you're holding things like dollars or treasuries over the long period of time, the things where the productivity growth is coming from are probably not getting more expensive than you. Like $1 can literally buy you like more television than it could 20 years ago. Like for a couple $100, you can get a decent television that's better than the television you could have gotten 20 years ago, because the productivity growth of making televisions has exceeded even the debasement rate of the dollar. Same thing for a lot of electronics and some textiles and things like that. On the other hand, if you were holding gold, then not only did you keep up with that, you can buy multiple TVs for the same amount, the same ounce of gold you could before. And Bitcoin's not been around for 20 years, but basically like asset managers and households are not particularly leveraged. And so when they buy something and they don't buy something else, that's a crowding out effect. That's a choice. And when they do that significantly enough, you get very levered. Like the amount of government debt relative to the size of the monetary base becomes very high. And that hit a peak in like 2008, where you had all very high public and private debts on a very thin monetary base. So way more claims for money than there actually are base unlevered dollars. And so their answer was, we'll just create a lot of dollars. And basically that is an anti-deflationary effect, because if you have a big like debt, like it starts to kind of implode on itself, then you'll start to get outright deflation pretty quickly, because you're literally like when there's there's something like 50 claims for dollars, like total debt, like 50 claims for dollars for every $1 in the system. So it's like a game of musical chairs with 50 kids and one chair, and the music stopped, which is like calamitous.
Obviously during COVID or the pandemic, it was even up to like 22%, I think, in percentage wise. So it has come down, but like structurally over time, I feel like if we project this out and we kind of feel, okay, there's no way this train can be stopped. So it seems like a given that this should be growing ever more. And that, again, would then allude to more debt monetization, more monetary debasement, and again, water on the wheels of Bitcoin, I would say.
Yeah, I think structurally, it's set to go higher, higher highs and higher lows, up to a certain point. I would also include the broader banking system. So not just the central bank, it's also commercial banks. So for example, in World War II, when the U.S. was financing, that was the biggest deficits they ever had to finance relative to the size of, or they can tweak bank rules and just let the banks buy more treasuries. So for example, in September of 2019, there was the repo spike. And people thought it was a repo problem, but there's some analysts such as myself and Luke Groman and others that were like, it's not really a repo problem, it's a T-bill oversupply problem. And sure enough, so the first thing the Fed did was they jumped in, they started supporting the repo market. That's kind of those like putting out the immediate fire. But a lot of hedge funds and other entities were using repo to buy treasuries. And so a bunch of us were like, they're going to have to buy treasuries. It's not really a repo problem. That's just a surface issue. And sure enough, by mid-October, the Fed comes out and says, we're going to start buying T-bills. I know it looked like a repo problem, but here's the technical jargon, and we're going to start buying T-bills, but we're not going to call it QE because we're not buying long duration treasuries, and the purpose isn't to stimulate, but we have to fix this plumbing issue by creating new bank reserves to buy T-bills because other pools of capital are kind of stuffed. Another thing is that during, but then now you owe a big chunk of taxes just for kind of keeping up with the money supply. So it's actually similar to by being diluted at the end of the day. And they can do that for gold. They can do that for Bitcoin. They can even target to go after assets higher than normal taxes. So if they particularly don't like an asset because it's like the best one or something like that, it's giving them the most headaches. And so governments do tend to want to add frictions or costs or taxes to try to recoup the fact that some people are trying to escape the debasement. They want to impose debasement because they want to tax. They want to spend more than they tax because that's popular. But then when there's obvious costs or some people are better at escaping that than others, they want to try to then close those like exit doors or offset those exit doors in various ways. And you see also, emerging markets sometimes do this with dollar power the U.S. government ever got. The president won, and then he had a super majority in Congress. So him and his party could practically get around all checks and balances because the country became so collectivist at the time. Public opinion was very collectivist. And they could even like potentially override the Supreme Court by stacking it when you have all the chips on one side of the table. So they could do pretty extreme things. I mean, they put people in internment camps based on their ethnicity. Like they went after journalists really hard. Like that was a very significant time.
Tough time, yeah.
And so one of the defenses against that kind of thing is to have enough polarity in government that it kind of gets in its own way. So one of the, right now in the U.S., the Republican Party embraces Bitcoin and crypto more than the Democratic Party, but it's not like 100-0 price, even though really only 5% of them traded hands, one out of 20. And the same thing happens to a less extreme scale with Bitcoin, that when you have a really big bull run, there's a fairly small amount of volume that's making the value of all coins higher. But some of that is kind of ephemeral. And then over time, generally speaking, you get a weakening of the market cap and you get a steadily increasing of the kind of the cost basis as more and more coins trade hands. And so generally buying in periods where you have that really big dislocation increases your odds of having a negative year despite positive liquidity. So by looking at both liquidity conditions and looking at relative valuations, that can generally help entities, have a reasonable view of what might happen over a given 12 to 24 month period with the asset.
Yeah, exactly. Yeah, I mean, the on-chain metrics that you mentioned, I think I had James on check on the podcast as well, and we kind of elaborated on these as well. So definitely very helpful. I mean, I read the paper as well, and I will surely linking in the show notes as well. One question that I would be having:
liquidity easing. So they're going to have to, I think, pull a couple levers by the end of next year, and that probably means stopping quantitative tightening. Even if you look at the annual report that the Fed put out earlier this year, they even predicted that by the end of 2025, they'll probably go back to the end of quantitative tightening. And they describe it as like they chart out their expectations of keeping their balance sheet at a similar percentage of nominal GDP. So as GDP goes up, their central bank balance sheet goes up, and they're gradually, monetizing some of the deficit, even though they wouldn't use that term. And it's not for the purpose of stimulus, but it's the purpose of not having bank reserves shrink relative to bank assets and relative to the size of everything else. So I do think that, by the end of the next year, we'll have that going on, which is a pro-liquidity move.